Hi everyone, my name is Edwin Lim. In this video, we will cover topic 1, Introduction to Accounting. In this topic, we will look at some key accounting principles such as the assumptions we apply when we prepare financial statements. We will also look at the differences between cash accounting and accrual accounting. And we will highlight accrual accounting is more important and it will produce more useful information compared to cash accounting. We will also spend a little bit more time on the Conceptual Framework, which is the foundation of financial reporting. The Conceptual Framework prescribes the objective of financial reporting, and it also prescribes the qualitative characteristics of information. So in other words, the Conceptual Framework actually tells us the criteria that we need to apply to judge whether financial information is useful. According to the framework, there are two fundamental qualitative characteristics which include relevance and faithful representation, and it also includes 4 enhancing qualitative characteristics which include comparability, verifiability, timeliness, and understandability. And we will also look at the definition and recognition criteria of accounting elements, which includes asset, liability, equity, income, and expense. Next, we will also look at key financial statements. And we will be looking at 3 key financial statements. They are income statement, balance sheet, and the cash flow statement. Finally, we also introduce accounting equation. Accounting equation is important because it forms the basis of double entry recordings that we will cover next week. Alright, the next slide shows the learning objectives for this topic. And it's important that you go through these learning objectives when you do the reading and revision. And make sure that you understand each of these learning objectives because learning objectives pretty much reflect what will be in the exam. Alright, what is accounting? To put it in a simple way, accounting is the language of business. We use accounting to identify, measure, record, and communicate economic information to users for decision making. So let's have a closer look at each keyword. What does identifying mean? Identifying means we look for inputs. We need to make sure that there is a past transaction or past event for us to record. For example, we will search for source documents. When there is a receipt, when there is an invoice, a transaction is identified. And what does measuring mean? Measuring means we quantify the item in dollar cents. We give the item a monetary value or a dollar value. And what does recording mean? Recording means we will classify the item, whether it is an asset, liability, equity, income, or expense. We then perform double entry. We record the transactions in accounting books such as ledgers and journals. And what does communicating mean? Communicating means we will prepare financial statements such as the cash flow statement, the income statement, and the balance sheet to tell people about the financial performance and financial condition of the company. Is the company liquid? Is the company profitable? Can the company survive in the future? And there are 2 types of accounting: financial accounting versus management accounting. And they serve quite different functions. In this unit, we focus more on financial accounting, and you will get to learn more about management accounting in a separate unit. Financial accounting focuses on providing financial information to external users. So examples of external users include shareholders, customers, suppliers, and so on. Financial accounting focuses on reporting financial performance and position. Financial performance shows profitability of the company, whether the management is efficient, whether the management can generate revenues by using minimal amount of resources. And financial reporting will also reveal financial position. Financial position means financial structure, how much debt and equity the company has. And it actually reveals financial stability and financial condition of the company. On the other hand, Management accounting focuses on providing information to users within the enterprise. So it means it provides information for internal users. And who are those internal users? Managers, CEO, CFO, the board of directors. So what are the examples of management accounting information? Think about costing, budgets, and forecasts. Managers will use this information to plan and to make controlled decisions. For example, whether to buy more products or to cut down the purchase, whether to continue or discontinue a division. This slide shows that we have different uses of information. We have investors or shareholders who rely on accounting information to make investment and pricing decisions. And what does investment decision mean? It means whether to buy, hold, or sell the shares of the company. Whereas pricing decisions mean how much are shareholders willing to pay to purchase the shares, and how much would they sell for the shares. So what is the cost of equity? Investors also use accounting information to monitor managerial performance. This is to evaluate whether managers have done a good job, and if they act in the best interest of shareholders, who are the owners of the company. If not, shareholders can put pressures on the company to sack the managers. Banks and lenders also use accounting information to make lending decisions, whether to provide loan to the company. And they use accounting information to determine the cost of debt. In other words, what should be the interest rates, what should be the loan spreads. And banks will also use accounting information to calculate some ratios to see if the company has complied with debt covenants. Debt covenants mean agreements that are set by lenders, and borrowers must follow those agreements. For example, the company cannot borrow from other banks, or the company must maintain a degree of liquidity, profitability, or leverage ratio. Managers also use accounting information as mentioned in the previous slide when we talk about management accounting. So costing, budgeting, forecasting information will be used by managers to plan and manage the entity. And note that managerial compensation, such as bonus, quite often is tied to accounting figures. For example, if managers earn more profit, they will get more bonus. That explains why sometimes managers have incentives to engage in creative accounting or opportunistic accounting to manipulate the profit figures because they want to maximize their bonus. Government and regulators will also look at accounting information. For example, the Australian Taxation Office, the ATO, relies on accounting information for tax assessment. If you earn more income, you pay more tax. The Australian Securities and Investment Commission, the ASIC, will make sure that companies comply with accounting standards when they prepare financial statements. This is important because we need to make sure that every company follows the accounting standards, follow the same rules, and accounting information is reliable and useful for decision making. Employees and unions are the next users. Employees look at financial statements to evaluate job security. They need to make sure that firms can operate in the long run. Unions will look at financial statements to fight for employee benefits and welfare. Usually, large firms and profitable firms will be targeted by unions. And unions are very influential in Australia, and they serve to preserve social justice and equity. Next, competitors in fact also look at the business financial statements because they can tell or they can deduce the profit margins of the products by looking at the competitors' firms' financial statements. They will follow the company's business strategy if the products are profitable. Customers also look at financial statements, especially those major customers, because major customers prefer stable business relationship, so they prefer to deal with profitable and growth firms. Finally, suppliers also look at accounting information to determine the credit decisions, whether to give the customers credit sales, and if so, what will be the credit terms? Is it 30 days, 60 days, or 90 days? So how do we prepare financial statements? To answer this question, we need to rely on the conceptual framework. The conceptual framework is the theory of financial accounting. It is the foundation of accounting standards. In other words, regulators set accounting standards by referring to the principles in the conceptual framework. And every accounting student should read the conceptual framework. You can obtain a copy of the conceptual framework from the AASB website. So what is the difference between the conceptual framework and accounting standards? They are not the same. The conceptual framework is a set of broad principles that guide us in making decisions in financial reporting. On the other hand, accounting standards are specific requirements that entities must follow to measure, record, and disclose accounting information. And of course, the conceptual framework is the foundation of accounting standards because accounting standards are formulated based on the conceptual framework. The conceptual framework consists of principles at a broader level. For example, it defines asset as a whole. It does not deal with any specific type of asset. So in the conceptual framework, you cannot find anything about property, plant and equipment, inventory, or intangible assets because it only deals with asset as a whole, for example. However, accounting standards are actually much narrower. So different asset and liability are handled by different accounting standards. For instance, IAS 38 or AASB 138 prescribes the accounting treatment of intangible assets. And you find that we usually assign a specific number or code to accounting standard that covers different accounting items. But note that we need both the conceptual framework and accounting standards because it is not possible to cover every single situation or scenario via accounting standards. Because we can have 1 million scenarios in the business world. If a particular problem is not covered by accounting standards, we need to fall back on the conceptual framework to decide the accounting treatment. However, sometimes accounting standards and the conceptual framework may suggest different treatments. Sometimes they are conflicting. You will get to see this when you move to a more advanced accounting unit. When there are conflicts, which one should we follow? We should follow accounting standards because accounting standards have legal backing. The conceptual framework answers a few questions. Who has to report? To whom should they report? Why do they have to report? And what need to be reported? So what is the objective of financial reporting? According to the conceptual framework, it is to provide financial information about the reporting entity that is useful for existing and potential investors, lenders, and other creditors to make resource allocation decisions. Let's look at some of the terms in this objective. Reporting entity means entity whose financial information is useful to users who cannot directly ask for those information for decision making, because those users do not participate in the management of the entity, and those users have provided resources such as funds or goods to the company. And if you look at the objective, the conceptual framework specifies 3 types of users: investors, lenders, and creditors. But in the earlier slide, we have mentioned that in real life, we have more users. For example, employees and customers will also rely on accounting information for decision making. Next, the conceptual framework is concerned with general purpose financial statements rather than special purpose financial statement. So what does it mean by general purpose financial statements? So those are the financial statements or reports prepared for users who are not in a position to ask for special reports tailored to the information needs. In other words, these people do not participate in the internal management, and these people are not that powerful to ask for special reports. Examples of general purpose financial reports include income statement, balance sheet, and cash flow statements. And the objective of financial reporting highlights that the information must be useful. So how do we judge whether information is useful? There are 2 fundamental and 4 enhancing qualitative characteristics. So we will discuss them in the next slide. First, let's have a look at the 2 fundamental qualitative characteristics. First, relevance. Relevance means the information must be related to the decision making. For example, it can help us to predict or confirm outcomes. By looking at a company's profit figure, can we actually predict the growth in the future, for example? And relevance is judged by materiality. Materiality means information that is significant enough to influence our decision. And therefore, such information should be correct and it should not be omitted. And note that materiality requires a degree of professional judgment. It is an entity-specific concept, meaning it is a firm-specific concept. What is material to one entity may not be material to another entity, because company operates in different industry, company operates at different size, and company encounters different business scenario, and therefore materiality is a firm-specific concept. The second criteria is faithful representation. It means accounts reflect actual events or transactions. And there are 3 important elements here. Completeness. Completeness means adequate or full disclosures of all necessary or relevant information. And note that we do not expect companies to disclose every single information. That is not possible and it will be too costly to do so. But we do expect companies to disclose all necessary or relevant information. And the second notion of faithful representation is neutrality, means fairness or free from bias. And the third element will be free from error, means there is no mistake. So faithful representation and relevance are considered to be the most important quality of information according to the conceptual framework. In addition, there are 4 enhancing qualitative characteristics. First, verifiability, which means financial information can be supported by evidence and it can be audited. For example, you refer to source documents such as contracts, receipts, and invoices. Second, comparability, which means the same accounting standards or the same methods or policies have been used by different entities. So you can meaningfully compare the performance and position to see which firm is better. Comparability also includes the notion of consistency, where the same accounting methods have been applied from year to year, so we can conduct time series comparisons. Third, timeliness. Timeliness means we need to provide information in a timely manner to influence users' decision making. And there shouldn't be any significant delay, because if there is a significant delay, information contains no value. Information becomes useless. Finally, understandability. Understandability means financial information needs to be presented clearly and concisely. It needs to be comprehensible. It needs to be understandable to users with reasonable knowledge of business and economic activities. Note that the conceptual framework actually assumes that the users of financial statements do possess some accounting knowledge and finance knowledge, so they have a degree of financial literacy. However, we should not exclude complex items just to make the reports simple and understandable. When we prepare financial statements, we rely on a few key assumptions. First, accounting period assumption. We assume that the companies will operate indefinitely, so they'll operate in the long run. However, for reporting purposes, we will divide the business life into equal time periods. For example, you can divide the business life into 6 months. So every 6 months, every 12 months, or every 3 months, you prepare a financial report. The accounting period must be uniform and consistent so we can compare the results more meaningfully. Second, accounting entity assumption. Accounting entity assumption means the transactions of a business and the transactions of the owners must be separately accounted for. They should not be mixed up. However, this assumption is usually a problem for small business or family-owned business. Third, monetary. Monetary assumption means the activity is recorded using one single currency, for example, AUD. So we can add and deduct the figures. The fourth assumption is historical cost assumption, which means the transactions are initially recorded at their original cost. We can always refer to source documents such as invoices and receipts to obtain the historical cost. And what is so good about historical cost? The good thing about historical cost is that it is objective. Because everything is in black and white, it can be verified, it can be proved by looking at the source documents. There is no managerial assumptions, there is no managerial manipulation. But there is one significant problem with historical costs. Historical costs can be backward looking. It ignores inflation. It fails to reflect the current value of the item, and therefore historical cost is not relevant when time passes. For example, 10 years ago, we purchased a building at $5 million. That is the historical cost. But now, the building may be worth $10 million. The fifth assumption is going concern assumption. It means the company will operate for the foreseeable future, beyond the next 12 months. And the company does not have any intention to shut down. Because of this reason, you find that when we define asset and liability, we think from a long-term perspective. So you see the word future economic benefits and future economic sacrifices when we define asset and liability, because we assume that the company will operate in the long run. So we define asset and liability from a long-term perspective as well. And this assumption is important because if the company is no longer a going concern, meaning if the company is going to shut down in the next 12 months, we need to prepare the financial statements based on a liquidation basis. Finally, materiality. As explained, we must disclose information that is material, that is significant enough to influence decision making. And the information should not be omitted or contain any errors. Think about it. We have thousands and millions of information. If we run a business, we cannot and we do not want to disclose everything because reporting and disclosures are costly. So we will prioritize based on the materiality concept. The next slide shows how the 6 assumptions are reflected in a company's financial report. If you look at Rubicor Limited's annual report, you find that the report only records transactions for the business under the accounting entity assumption, so nothing about the owners. And it has disclosed all the material information. It records most of the items using historical costs, with some exception at fair value. And the unit of currency is Australian dollars. The company is expected to operate for the foreseeable future under the going concern assumption. And 30 June actually marks the reporting date. Note that in Australia, our reporting date starts from 1st July and ends at 30th June. But in other countries, mostly starts at 1st January and ends at 31st December. But in Australia, between 1st July to 30th June in the following year. Now, let's look at the definition and recognition criteria of accounting elements prescribed by the Conceptual Framework. The Conceptual Framework defines 5 accounting elements, namely asset, liability, equity, income, and expense. We can only record these elements when both definition and recognition criteria are met. And it is important that you learn the definition and recognition criteria of these elements by heart. Alright? And we will discuss this definition and recognition criteria in the next slide. First of all, let's look at the definition of asset. Examples of asset includes equipment, land, inventory. First, we need to show control. Control means we have the right to use the resources, and at the same time, we preclude others from using the resources, meaning only our business can use it, others cannot use it. And control does not necessarily mean ownership. Let me give you an example. If you lease a building for 3 years, okay, under the lease agreement, you are the only one who can use the building to generate revenue, and other companies cannot use the building. Because you have the right to use the building, you control the building, you have to actually recognize the building as a lease asset. And how do we determine whether there is control? One of the ways is to see whether there is any contract. Next, we need to show that we can use the resources to generate future economic benefits. For example, it can bring cash inflows. And third, there must be a past event or past transaction that gives rise to the control. For example, you sign the contract or you purchase the asset. Now let's have a look at liability. Examples of liability include bank loan and provisions. First, there must be a present obligation. Present obligation can arise because of contractual arrangement. For example, you sign a loan agreement. And it can also arise because of legal requirements. For example, every company has a liability to pay tax. And note that we are not talking about future commitment. For example, if you have the intention to borrow 10 years later or 5 years later, that is future commitment or future intention, not present obligation. Following this, we also need to show that there are future economic outflows or future economic sacrifice. For example, you will incur cash outflows to settle the obligation. And third, you must show that there is a past transaction or past event that gives rise to the present obligation. For example, if you sign a loan agreement, that is a past event. Now let's have a look at equity. Examples of equity include share capital. It represents owners or shareholders' residual interest in the firm. It is measured as assets minus liabilities. Why is this so? Because under law, when a firm is liquidated, when a firm shuts down, all the liabilities and debts must be settled before equity. Therefore, equity will represent the residual interest in asset after deducting all the liabilities and debt. So what is income? Examples of income include sales revenue, interest revenue, and so on. For income, we need to show that there is an increase in economic benefits during the period. And how do we prove that? We show that there is a decrease in liability or increase in asset, leading to a net increase in equity. And we also need to make sure that it is not a contribution from owners. For example, if you talk about capital contribution, that is not income because capital contribution from owners will be classified as an equity. On the other hand, if you talk about sales revenue will be classified as an income because you generate the inflows from customers, not shareholders. Next, let's have a look at the definition of expense. Examples of expense include electricity, advertising, and so on. For expense, we need to show that there is a decrease in economic benefits during the period. And how do we prove that? So we show that there is an increase in liability or a decrease in asset, leading to a net decrease in equity. And note that it is not a distribution to owners. For example, if we talk about dividend, dividend is not an expense because you pay dividend to shareholders. It is a distribution to shareholders or owners. On the other hand, if you talk about electricity expense, that will be a form of expense because you are paying the electricity expense to the utilities company, not to the owners or shareholders. Alright, and not only an item must fulfill the definition criteria, they must also satisfy the two recognition criteria in order to be recorded. First, it must be highly probable to occur, or it has already occurred. And the probability of occurrence must be greater than 50%. Second, the transaction can be reliably measured. It means the transaction is verifiable. For instance, by looking at source documents, or the estimate is reasonable, for example, based on past experience, experts' valuation, or industry best estimates. So this slide shows the decision path. We ask the first question, has the item met all the definition criteria for a particular element? If the answer is no, we got to exclude it from financial statements. We cannot recognize it, otherwise it is misleading. If the answer is yes, we will follow up with the second question. Has it met the recognition criteria? Okay, and recall, what are the two recognition criteria? Probable occurrence and reliable measurement. If the answer is yes, we will recognize the item, meaning we will record it in the body of financial statements. If the item has met the definition criteria but failed the recognition criteria, what do? We cannot recognize it, meaning we cannot record it, but we may want to disclose it in the notes to financial statements if it is material. And again, the concept of materiality requires a degree of professional judgment. And what are notes to financial statements? Notes to financial statements are information explaining accounting policies or methods, and additional information that will be useful for users to interpret the financial statements. So if you look at slides If you look at your slide number 10, this will be an example of notes to financial statements. In the notes to financial statements, you disclose additional information, you justify your accounting policies or accounting method. This actually enables shareholders or users to better interpret your financial statement. Alright. Following this, let's look at an example. Burwood Enterprise is a media company. It heavily invests in marketing to attract customers. It also invests in staff training to improve customer satisfaction. The managing director of the company proposed to treat marketing and staff training costs as an asset in the company's statement of financial position. Okay, statement of financial position means balance sheet, if you like. So it's just an alternate term for balance sheet. So what is the requirement here? Based on the conceptual framework, can Burwood Enterprise recognize marketing and staff training costs as an asset? If not, what is the appropriate treatment? So let's apply the definition of asset. First of all, is there any past event or past transaction? Yes, because marketing and staff training have already occurred. Second, are there any future economic benefits? Arguably yes, because marketing can attract more customers and boost future sales revenue. While staff training can improve customer satisfaction, which leads to higher sales, and it can also improve efficiency, which will contribute to lower expense. However, is there any control? The answer is no here, because although there is marketing, we know that the company cannot control customers. it is up to customers whether to buy the products from the company. And although the company trains the employees, the company cannot control employees because employees may quit the job and join another company. So what is our decision here? Because marketing and staff training fail the control test, they fail the asset definition. When an element fails the definition criteria, we do not need to discuss the recognition criteria. So, what will be the appropriate accounting treatment? The marketing and staff training costs should be expense. Here, we need to apply expense definition and discuss each of them. Is there any decrease in asset or increase in liability? Yes, because when we pay cash for marketing and training, our assets become smaller. Alternatively, if we owe those expenses, the liability will increase. Next, is there any decrease in equity? Yes, because the reduction in asset or increase in liability will lead to a reduction in equity. Is it a distribution to equity participants? No, it is not a dividend payment to shareholders. Because all the definition criteria are satisfied, we need to discuss the recognition criteria. Is it probable to occur? Yes, marketing and trading already occurred. Can they be reliably measured? Yes, because we can always refer to the past records, the past transactions. So there are always invoice and receipts that we can look at. So what is the conclusion here? Because marketing and staff training costs meet both definition and recognition criteria of expenses, they can be classified as an expense. Now, let's have a look at the second example. In this example, an employee Bob suffered from head injuries at work. Poor thing. Bob sued the company for damages because the company fails to comply with workplace health and safety regulations. The court has concluded that the company is indeed liable for it, meaning the company actually loses the case. However, the court has not finalized the amount of compensation. Questioned, should the company record the damages to Bob as a liability? So let's apply the liability definition. Is there a present obligation in this case? Yes, because the court has concluded that the company is liable, and therefore this is legally enforceable. Are there any future economic outflows? Yes, because when you compensate Bob, there will be a cash outflows. Is there any past event? Yes, the decision of the court itself is a past event that creates the present obligation. Since all the definition criteria of a liability are met, we need to also discuss the recognition criteria. Are the outflows likely to occur? Yes, because it will be enforced by the court, the company must compensate Bob. Finally, can the compensation be reliably measured? In this case, no, because the court has not determined the compensation, and we can't tell whether the company needs to pay Bob $10, $1,000, or $1 million. So what is the conclusion here? The obligation to pay damages cannot be recorded because it fails the reliable measurement test. However, the company should disclose this event if they expect the compensation or the damages to be material or to be significant. Alright, here is your first student task. What is this case about? Joe, the managing director, has signed a restrictive covenant. Under this agreement, he will get $250,000 if he resigns, but he cannot work in competition with the firm for a period of 3 years, meaning he cannot actually create his own firm in the same industry, or he cannot join a competitive firm. If Joe breaches the condition, he is required to compensate the company $500,000. Questioned, can the company, Ping Limited, recognize the restrictive covenant as an asset? So discuss fully in reference to the conceptual framework. So let's assume that you have attempted this question. First of all, we have to look at the asset definition test. Is there any past event or past transaction? Yes, a restrictive covenant was signed. Next, are there any future economic benefits? Yes, because under the agreement, Joe cannot work in competition with the company for 3 years. This, to a certain extent, maintains the company's market position in the form of less competition. So when there is less competition, presumably you will have more future economic benefits. But is there any control? Perhaps no in this case. Although the covenant is legally enforceable, Joe can still breach the covenant and compensate the company $500,000, because arguably $500,000 may not be a lot. And the competitor may actually cover the compensation if they believe that the benefits of hiring Joe actually outweighs the cost. So you'll find that human is not controllable after all. Because it does not meet all the definition criteria of an asset, we do not need to discuss the recognition criteria of probable occurrence and reliable measurement. And always give your conclusion, guys. So in this case, the restrictive covenant cannot be recognized as an asset. Alright, in the next few slides, we will cover accounting equation. So we'll do a little bit of calculation. So recall that the definition of equity, it is a residual interest in asset after deducting liability. So mathematically, equity equals to asset minus liability. If we rearrange the equation, asset equals to liabilities plus owner's equity. And owner's equity actually has two main components. First, capital. Second, retained profits. And what is capital? As mentioned, capital are contributions from owners. For example, share capital. And what are retained profits? Retained profits are accumulated profits not distributed to owners or shareholders. And what is the function of retained profits? We retain profits for further investment or business expansion because we want the company to grow. And how do we calculate retained profits? Retained profits at the end of the year, meaning the closing retained profits, equals to opening retained profits, meaning retained profits at the beginning of the year, plus net profit minus dividends. And how do we calculate net profit? Revenue minus expense. When your revenue is greater than expense, you have net profit. If your revenue is less than expense, you will have a net loss. And what is dividend? Dividend is a distribution of profit to shareholders. Okay, and note that we only distribute a portion of profit rather than the full profit because we want to maintain some profit in the company for future expansion. And note that dividend is not an expense. Finally, if we plug in all this relationship, we can expand the accounting equation. Asset equals to liability plus capital plus opening retained profits plus revenue minus expense minus dividends. Note that the accounting equation must always balance. What does it mean? It means the right hand side total figure and the left hand side total figure must always be the same. So let's look at one example. We can apply accounting equation to the following examples. In the first example, it's given equity of 4K, 6K of asset. How much is the liability? So we know that asset equals to liability plus equity. When we rearrange the equation, we derive that liability equals to asset minus equity. So liability in this case equals to 2K, 6K minus 4K. In the second example, you are given revenue 2.4K, expense 1.6K, retained profits at 1st of July, that is your opening retained profits, 1.4K, and you have retained profits at 30th of June 2016, that is your closing retained profits, 1.7K. So how much dividend has been declared? Apply this formula. opening retained profit plus net profit minus dividend equals to closing retained profit. So if you plug in the figures and rearrange the equation, you get dividends of $500. Your student task. So during the year ended 30th June 2016, Chi Limited reported 12K asset, 4K capital, 4K revenue, 2K expense, 3K dividends. The retained profits at 1st July 2015 was 3K. So this is actually the opening retained profits. Alright, and guys, please change the question here a little bit. Sorry, there is a typo error. What was the liability reported by Chi Limited at 30th June 2016? Because in this question, we have already given you the asset. So we are asking you about liability. You need to derive the liability. So please change asset to liability. So let's assume that you have actually done this question. We can apply this long equation. Asset equals to liability plus capital plus opening retained profits plus revenue minus expense minus dividend. So when you plug in all the figures and rearrange the equation, liability equals to $6,000 in this case. Alright, in the next few slides, we are going to look at several differences between cash and accrual accounting. Cash accounting only recognizes revenue when cash is received, and they will record expenses when the cash is paid. The good thing about cash accounting is objectivity, because it does not involve any subjective estimates. However, the timing of cash flows and the timing or substance of transactions do not always coincide. For example, we may actually sell the goods on credit. If we sell the goods today, we have actually earned the revenue, but we have not received the cash because we will only receive the cash in a future period. So you find that there is actually a mismatch between cash flows and revenue earned if we were to apply cash accounting. Let's have a look at another example. The second example is actually related to depreciation. We will have a chance to look at depreciation a few weeks later. So what is depreciation? Why do we depreciate the asset? Because we use the asset to generate revenues, but assets have limited useful life. We can only use asset to generate revenues for a period of time, and they are subject to wear and tear. When assets get older, its usefulness actually diminishes. So we have to actually recognize depreciation in this case. And depreciation is actually a form of expense. And in this exercise, there is no cash involved at all, because depreciation is considered as an internal adjustment or a balance day adjustment that does not have any cash flow effect. Okay, let's have a look at the third example. The third example, we receive the service now, but we will pay for the services in a later period. So what does that mean? This is actually an example of accrued expense. You have already consumed the services, so there is an expense, but you haven't paid for that expense. So expense now, cash later. Okay, so it's also called accrued expense. And we will look at accrued expense in week 3. Okay, and in fact, accrued expense is actually a form of liability, if you like. Means payable. And if you look at another example, you may receive the money in advance from customers, but you will only provide the services or goods in the future period. Examples will be magazine subscriptions and airline tickets booked. Okay, so in this case, you receive the cash now, but you haven't really earned the revenue because you have not provided goods and services. So this will be an example of an unearned revenue. Okay, so we will also cover unearned revenue in week 3. Sorry about my handwriting, it's too difficult to write on the screen. Unearned revenue. And unearned revenue, in fact, is also a form of liability. So these examples highlight that the cash flows and the timing of the revenue and the timing of expenses do not always coincide. They do not always happen in the same period. So to deal with all these complexities and to make sure that accounting information is useful for decision making, we actually use accrual accounting. And what does it mean by accrual accounting? Under accrual accounting, we record revenue when it is earned and we record expenses when they are incurred. So not necessarily whether the cash has been received or paid. So under accrual accounting, it actually satisfies the matching principle, which is a very important concept. Okay. And what is matching principle about? Matching principle means we will recognize the revenue and expenses incurred in the same period. So profit is more useful for decision making. Okay. Okay, matching. However, accrual accounting is not perfect. There are some limitations about accrual accounting. One of the limitations is that it may actually require some subjective estimates. So for example, when we estimate depreciation, when we estimate impairment, it actually requires a degree of professional judgment, and those judgments may be subjective and it can be subject to manipulation. Alright? But generally, we need accrual accounting because it produces more meaningful profit for decision making, because we recognize revenue and expense around the same period. Okay, let's have a look at a few examples. In the first case, $2,000 of goods are sold to customers in June, but the customer will only pay in July. This is an example of credit sale. If we were to apply accrual accounting, we will record the revenue in June or July in this case. In this case, we will record it in June because we have sold the inventory to customers in June and we earned the revenue in June. Second, $8,000 of airline bookings was received from a customer in June, and the customer will not fly out until December for Christmas. So what is this about? So this is actually an example of unearned revenue, if you like. Okay, because you receive the money from the customer now, but you have not provided the goods and services. Okay, remember we've talked about unearned revenue just now. And what is unearned revenue? Unearned revenue is actually a form of liability. So if we were to apply accrual accounting, when should we recognize the revenue in this case? In this case, we can only recognize the revenue in December when the customers fly out, when the customers actually use the services. Let's have a look at the third example. $5,000 of advertising paid for in cash by Coles in June. The advertisements will not appear on TV until July. So this is actually an example of prepayment, if you like. We will also look at prepayment in greater details in week 3. Okay, so this is a form of prepayment. And prepayment, in fact, is a form of asset. You pay now, but you will only use the services in the future period. So if we were to apply accrual accounting, when should we recognize the advertising expenses? We will only recognize the advertising expenses in July in this case, because we will only consume the advertising services in July. Alright, student tasks. So for each of these items, you need to discuss whether there is any effect on the accrual profit and whether there is any effect on cash. So let's go through each of them. So first of all, when company issues shares, how would you classify share capital? Share capital is actually a form of equity. It does not affect revenue. It does not affect expense. So there is no effect on accrual profit. When you issue shares, you receive cash from shareholders, so plus 120k under the cash column. Next, borrow funds. Borrow funds is a form of liability. So what do you do here? So issue shares is actually a form of equity, and borrow fund is actually a form of liability. So when you borrow fund, when you get a loan, it does not affect your accrual profit. There is no revenue, there is no expense. Okay, but you will get cash of $20,000. So plus $20,000 under the cash column. Third, when you pay interest expense of $1,900, as you know that interest expense is actually a form of expense, and of course it will affect your accrual profit. So in this case, your accrual profit actually reduced by $1,900. And when you pay interest, there is a cash outflows. Okay, when there is a cash outflows, you have to put minus $1,900 under the cash column. Next, we bill clients $350,000 for the work performed in June. Okay, so this is the service revenue, and you know that service revenue is actually a form of income. Because you have performed the entire work, you have earned $350,000. So your profit will increase by $350,000. But have you received the full payment in this case? No, you have only received $320,000. So plus $320,000 for the cash column. Next, you have wages expense. Wages expense, of course, is a form of expense. Okay, so expense would definitely reduce your accrual profit. So your accrual profit will reduce by $32,000. And when you pay your employees, there will be cash outflows. So negative $32,000 under the cash column. Next, you have advertising expense. You have incurred the expense. So again, expense will reduce your profit. So what happens to your profit? Your profit will decline by $500. But have you paid for the advertising? No, you have not, because you only pay for the advertising next month. So there is no effect on cash at the moment. And finally, you pay dividends of $45,000. Okay, so is there any effect on accrual profit? No, because dividend is not an expense. It is a distribution to shareholders. Therefore, it will not affect your accrual profit. And is there any effect on cash? Of course, when you pay your shareholders dividends, there will be cash outflows. So negative $45,000 here. If you sum the column A figures, you get your accrual profit of $315,600. And if you sum your cash columns, you get your change in cash of $318,100. Alright, in the next few slides, we will look at a few key financial statements. Balance sheet is also known as the statement of financial position. It shows the financial position of an entity at a point in time. Financial position means financial structure and financial stability. It shows the financial structure of the entity, meaning what are the resources, what are the assets, and how are those assets financed by liability versus equity, and whether the entity is financially healthy. Next, income statement, which is also known as profit and loss statement. It shows the financial performance of an entity over a period of time. So revenue and expenses will be reported here, and it shows whether the entity is profitable. Finally, cash flow statement. Cash flow statement shows the cash inflows and cash outflows of operating, investing, and financing activities over a specified period of time. So we will look at the format of these financial statements in the next few slides. This is the columnar format for balance sheet. For the title, we start with company name, okay, balance sheet, and then asset reporting date. Note that this is the term that we need to use when we prepare a balance sheet, asset, because the balance sheet shows the balance of asset, liabilities, and owner's equity or shareholders' equity at a particular point in time, only for this particular day. Under assets, we always start with the most liquid asset, which is cash. Cash is king. It is the most liquid asset and therefore it is listed first. We then have accounts receivable. Accounts receivable means you have provided goods and services to customers on credit, but you will receive this money from them in the next 12 months. Then you have inventory, which are goods or merchandise. Then you have property, plant and equipment, including land and building, motor vehicle. If you sum up those figures, you get $120 million of total asset. Under liabilities, you have accounts payable. And what is accounts payable? It means you have actually purchased the goods and services on credit, but you will only pay your suppliers or creditors in the next 12 months. You have wages payable if you owe your employees money, and you have taxes payable if you owe the taxation authority the income tax or the GST. We have long-term loans, which is the borrowing from the bank, and if we sum those liabilities, we have a total liabilities of $53 million. Next, let's have a look at the shareholders or owners' equity. Under this section, you have share capital. So share capital shows how much shares you have actually issued so far. In this case, 50 million. And you will have retained profits. Remember, retained profits are accumulated profits that are not distributed to shareholders. You keep it because you want business expansion and further development. So $17 million. So if you sum the two figures here, you get $67 million for total shareholders' equity. And you will sum up total liabilities and total shareholders' equity. You get $120 million, which is the same as your total asset. This is very important because under the accounting equation, asset equals to liability plus equity. So your accounting equation must always balance. Here, you have 120 million for asset, and the sum of liability and equity is also 120 million. Okay, the next slide is also another example of balance sheets, but it is under the side-by-side format. Okay, the same thing. You put each of the asset at the left-hand side, and you will list the liabilities and you will list liabilities and equity at the right-hand side. The total figure at the left-hand side must always equal to the total figure at the right-hand side. In this example, you also see the distinction between current, non-current. And what are current and non-current? We will explain them in the next slide. So current assets are those that will be converted to cash or used up within 1 year of the reporting date. Meaning within the next 12 months, they will be converted into cash or they will be used up. Examples include cash, account receivable, inventory, and prepayments. Non-current assets can generate economic benefits in the longer term, so more than 12 months. For example, property, plant and equipment, intangible assets, and investments such as shares and other securities intended to hold for more than 12 months. Now, what are current liabilities? Current liabilities are those to be paid out in 12 months. Examples include accounts payable, employee entitlements. So what are the examples of employee entitlements? You can think about provision for sick leave, provision for annual leave. And we will cover those provisions in week 10. You can think about tax payable. It can be GST payable or income tax payable. And you also have interest payable, bank overdraft. And what is bank overdraft? Bank overdraft means the company withdraws money from a bank account and the available balance actually goes below zero. Means the available balance goes negative. And you may also have dividends payable. Once you declare dividend, you have an obligation to pay the dividend. On the other hand, non-current liabilities are to be settled beyond 12 months. For example, mortgages, debentures. Debentures also means bonds. And you may have long-term employee entitlements. Example for this will be provisions for long service leave. It is important that we distinguish between current and non-current because we need to evaluate a company's short-term financial position. Alright, the next slide is a sample of income statement for retail or manufacturing firms. So we start with the title, Income Statement for the year ended. Okay, here we don't use the term asset. Asset is only for balance sheet. For income statement or profit and loss statement, we use the term for the year ended because we report the revenue and expense incurred for a particular period of time. Okay, so we start with sales revenue. We minus cost of goods sold. That will give us the gross profit. And then we will minus all sorts of operating expenses, which include salaries, depreciation, electricity, travel, postage, and so on. That gives us operating profit before tax. And we'll further deduct income tax expense to get operating profit after tax. Alright, based on the following information, please prepare an income statement. So I assume that you have done this question. So let's see whether you come up with the correct answer. So again, you start with the name of the company, Sunny Proprietary Limited. Income statement for the year ended. Please use the correct term, 30th June 2016. So we have revenue, sales revenue, $20,000 plus $29,000. You have to sum up the credit sales and cash sales together. So you have $49,000. You deduct cost of goods sold, $21,000. That gives you the gross profit, $28,000. And you will deduct all sorts of expenses, which includes wages, $8K, interest, $2K, rental, $2.5K, marketing, $1K. So the total expenses is $13.5K. So gross profit, $28K, minus total operating expenses, $13.5K. That gives you your net profit, $14.5K. Following this, we need to understand the relationship between income statement and the balance sheet. We can explain this using some equations. Previously, we mentioned that we report net profit in the income statement. And how do we calculate net profit? Revenue minus expense. And net profit is a part of retained profits. Remember, because we don't fully distribute net profit to shareholders. We only distribute a portion of net profit to shareholders as dividend. The rest will be kept in retained profits. And how do we calculate retained profits? Closing retained profits equals to opening retained profits plus net profit minus dividend. Okay. And note that we actually disclose retained profits under owner's equity. It is part of the owner's equity on the balance sheet because owner's equity equals to capital plus retained profits. So because of this, the income statement and the balance sheet are related. Alright, finally, let's look at statements of cash flows. You will learn more about statement of cash flows in a more advanced accounting unit. Today, we only give you an introduction. There are three types of cash flows. So cash flows from operating activities that show the cash movement from daily operations. For example, how much we receive from customers, how much we pay suppliers and employees, how much interest and taxes we paid. Cash flow from investing activities will show the cash movement for purchasing and selling non-current assets. For example, how much do we pay when we purchase a property, plant and equipment? And how much do we receive when we sell the property, plant and equipment? Cash flows from financing activities will show the cash movement relating to financial structure. For example, how much loan we obtain, how much loan we repay, how much shares we issue, and how much dividends we distribute and pay. This is the format for the cash flow statement. In the title, the same thing we will use for the year ended. We don't use as at because we try to show the cash movement for a particular period of time. And we will classify the cash flows into three parts, remember, operating, investing, and financing. And we have a subtotal for each part. We then sum up the subtotals. That gives us the total net cash flows. And we need to add the total net cash flows to opening cash balance in order to get the closing cash balance. And the total cash balance, the closing cash balance here must equal to the cash at bank account that you report on balance sheet. Alright, student tasks. So please classify each of the following items. Cash paid to employees will be classified as operating cash flows. Cash borrowed from bank, financing. Cash proceeds received from sale of investment in another company. This will be investing. Income taxes paid, operating. Repayment of loan, financing. Cash received in return for issue of share capital, financing. Cash received from customers, operating. Purchase of property, plant and equipment, investing. Cash paid to suppliers, operating. Cash paid for dividends to shareholders, that will be financing. Repayment of loan interest, operating. Alright, so finally, please prepare for this question and we will discuss at the beginning of the next topic.